Good afternoon, and welcome to today's webinar, 5 Smart Investing Strategies. My name is Nathan Crampy. I am a certified financial planner and vice president here at Summit Investment Advisors.
Five smart investing strategies. While there are many sound investment approaches, we're going to review 5 that have the potential to benefit the greatest number of investors. So understanding these strategies can help with your portfolio's long-term results. I'd like to start off with an ancient parable that relates to investing. It's about some blind men who touch different parts of an elephant and they describe what they're feeling. Is that a lot of people are making limited judgments with limited data points. So for example, a lot of investors out there in Wall Street, everybody from Main Street to Wall Street is trying to figure out what's going on with interest rates. Is the Federal Reserve going to raise interest rates today? How will that impact the stock market? So again, what we want to do is focus on the bigger picture, the macroeconomic picture today, and try to help you make sound investment choices. Now this slide here illustrates a typical investment cycle for individual investors. So what you really want to do is buy low and sell high, but that's very difficult for a lot of investors to do. And what usually ends up happening is people buy high because there's a lot of enthusiasm in the market, and then when there's downturns in the market, they end up selling low. Now, one of the first things that we learn as investment advisors is we want to do just the opposite of this. We want to buy dips in the market. You know, if you could take that advice and buy in dips in the market, oftentimes the smart investors make a lot more money that way. Just one other example I'll give you on this fear, greed, market timing cycle. Right after Labor Day, one of the most wealthy investors, billionaire guru, Warren Buffett, was interviewed on CBNC's Squawk Box. And they asked Warren, they said, well, what do you think about the current interest rate environment? What do you think of China's stock market? And Warren, he said, well, you know, we don't talk about that a lot at our office. What we focus in on is buying stocks that are going to be worth more 10 years from now than what they are today. So again, he focuses on the long term, and we think that's very important, especially in today's volatile market environment. Let's talk about market timing. And this chart is very important to look at because there's been a lot of swings in the market recently. And what we're looking at here is the Standard & Poor's 500 average annual returns from 1994 to 2013. You'll see that in that 20-year time period, the stock market averaged a 9.22% rate of return if you're fully invested in the market. Now, what's interesting about this study here is that in this period of time, a 20-year period of time, there's on average about 251 trading days in the year. So that amounts to 5,020 trading days. So if you're out of the market 5 of the 5,020 trading days, your rate of return wasn't 9.22%, it was only a 7% average rate of return. If you miss the best 10 trading days, your average return dropped to 5.5%, and if you're out of the market for only 20 days out of 5,020 trading days, your rate of return was reduced down to 2%. So what we're illustrating here is you got to be really careful about market timing, and there's a lot of gurus and experts out there that say they manage hedge funds that can get in and out of the market quickly enough. However, we've looked at studies and we've asked for past performance results, and there's not any firms that we've ever come up with that have said, okay, we can efficiently time the market. The risk is that you're going to miss the upside of the market and miss out on average rates of return with your portfolio. So again, be really careful about trying to time the market. Now this is a very interesting study to look at. Let's focus in on the slide. So this is called the law or flaw of averages. It shows the Standard & Poor's 500 index between 1926 and 2013. The stock market actually averaged a 10%. So what this is showing us here is the market very rarely averages 10% growth. And oftentimes investors get impatient because their portfolio is not averaging 10%. Instead, what they have to do is you have to wait for good years, and sometimes you're going to have some marginal years, and on average you should earn about 10% over longer periods of time. There's a famous investor out there, his name is Peter Lynch. He's a longtime manager of the Fidelity Magellan Fund, and one of his quotes, he said, "There are no bad mutual funds, there are only bad investors." And I think there's a lot of truth in that statement. Next slide here, what we're talking about is asset allocation. And I'm going to focus in on the chart. What we're looking at is 91.5% of the performance of a portfolio is due to asset allocation, and only 8.5% of a portfolio's return is due to investment selection. So what is asset allocation? Well, asset allocation is the selection of your investments. So it could be the selection of stocks, bonds, real estate investment trusts, whether you're having international investments in your portfolio, small cap, mid cap, large cap. So a lot goes into asset allocation, and 90% of the rate of return of your portfolio is summed up in what investments you're actually diversifying into. And again, only 8.5% has to do with your selection. So what does this mean to you? Well, we find that a lot of investors these days are so focused on the fund selection, and they might be going, okay, well, we always want to have this investment because it's 5-star rated and has the lowest expense ratio, when actually they should be focusing more on how to diversify the portfolio. And I've always thought the cost of professional advice is a lot less than the cost of doing things wrong, especially when it comes to something as important as your kids' college, retiring on time, and you know, knowing and understanding and taking full advantage of the different tax laws. So if you don't know a lot about asset allocation, definitely I would recommend talking to a professional about it. Now, selecting among the different asset classes, again, 90% of the influence of your portfolio is due to how you select between these different asset classes. And, you know, we see mistakes being made in this area. I'll give you an example. I recently had a client that was referred into our firm that had a fairly sizable portfolio. It was right around $1 million in their nest egg. And in their portfolio, 50% of it was in a money market fund, 25% was in a stock fund, and 25% was in a bond fund. So I asked, I said, well, you know, the money market fund, they know and I know that that money market fund earns less than a 1% rate of return and that it's not growing at all. And so I said, well, why is it in the money market fund? And they said, well, you know, our in-laws told us that they got out of the market because you know, there was some issues going on and the sky is falling basically. And so we took our money out at that time. I said, well, when was that? And they said, well, that was about 3 years ago. So if you think about it, this investor, they've been sitting at 1% for the last 3 years with half of their nest egg. And what that is opportunity cost. It's really difficult to make up for those lost years of return and interest in the portfolio. So again, you know, if you're not sure about asset allocation, look for a professional's advice in this area. I love this chart. I'm going to focus in on it here for a minute. So this is investing across multiple asset classes, and what we're looking at here would be the different areas that you could potentially allocate into on a year-by-year basis over just the last, I believe we're looking at over the last 10 years. And let's follow one of the asset classes. For example, commodity investing in 2005 was the best return. It earned 21%. And then the next year it became the worst returning investment. And then in 2007, one of the best, and eventually one of the worst to the best to the worst. And it's quite a roller coaster ride. And I refer to investing in one type of investment. It's kind of like going down to Valley Fair and riding that big green roller coaster called the Wild Thing. So we want to avoid big swings in our portfolio. Right in the middle here, you'll see a diversified portfolio. So the diversified portfolio will give you kind of the smoothest ride over time. So it's kind of like riding that roller coaster down that Valley Fair called the Mild Thing. And the Mild Thing is a much smoother ride. And so instead of chasing returns, what we recommend to investors is spread out the risk, because we don't know what's going to be the next best asset class, and you want to be diversified. The investment selection process is where you're researching the funds or the securities to own inside of your portfolio. And there's a lot of great resources these days out there that are easily accessible online. We like to use things like Morningstar and Lipper ratings to build portfolios. We recommend that clients do try to find the best performing funds in each different areas. So if you think about this analogy, it's kind of like building a team of baseball players. So selection process where you're hand selecting the best performers in each category. For example, you want to find the best large cap growth fund, you want to find the best international fund, and we're recommending to our clients to make sure you're using hedged international funds. We want to try to find best bond performers and so on and so forth. So if you're loading up your portfolio and your asset allocation with some of the best performing funds out there, you're going to end up with an all-star team. That can be a lot to keep track of as the economy changes. If international investing is stronger, well, maybe you want to put more money there. Or if interest rates are going up here in the United States, maybe you want to shorten the duration of your bond portfolio. If you don't have time or the inclination to be doing this stuff on your own, again, try to find somebody to help you that's a qualified professional that can help you allocate the team and with your investment selection process. Long-term look at performance, as you'll see in this next chart here, stocks over time historically have given the highest average, a better return than bonds, a better return than just having cash in your portfolio. But this can actually change on a year-by-year basis. So let's look at this scoreboard here. I'm going to focus on the slide for a minute. So which asset class had the best performance? So we have cash, bonds, and stocks. And then we go year by year. So you can see in 2005 and 2006, stocks had the best average growth rate. But then in 2007, bonds did better than stocks. And then in 2008, when the market had a downturn, cash was a better performer than bonds and stocks. So you can see year by year, the asset class that performs best is going to change. And what you want to do as investors is possibly adjust those asset classes or have diversification. So, if there is a correction in the market, that you're leaving those types of investments invested for the longer term. Let's talk about dollar cost averaging. Now, dollar cost averaging, I've included a couple slides here, and it's low. I'm not going to go through them, but you can print these or we can email these out to you. But basically what you're doing with dollar cost averaging is investing on a periodic basis. Typically, people will be investing into their 401k or stock purchase or IRAs on a monthly basis. Some people do dividend reinvest into their stocks. What we've found over and over again through time, and I do basically in a year's time, I'll do 100 financial plans. In 25 years, I've done over 3,000 financial plans. The investors who I find have the most amount of money in their portfolios and their nest eggs are the ones that have systematically dollar cost average and purchase securities over time. So they don't start and stop and get in and get out. Instead, they continue to buy into the portfolio. That's what dollar cost averaging is all about, sticking to a plan and continuing to invest over time. Let's talk about balancing your portfolio. So balancing your portfolio, I'm going to take a look at the slide here. What we're illustrating is a conservative portfolio, and we show this diversified between 20% stocks, we have 20% in bonds, and 60% in cash. And this is over a 20-year time period. The average annual return has been 6.1%, with a worst year of 12% and a best year of 15%. So in this example, the average was 6%, which isn't too bad. However, 10 years ago, cash was probably a decent investment where you got, maybe a 5% rate of return on it or 5% interest rate, where these days cash is paying below 1%. So this portfolio probably wouldn't earn 6% going into the future. Now let's look at another portfolio. This one is our aggressive portfolio. It shows stocks at 80%, bonds at 10%, and cash at 10%. So initial investment $100,000 over 20 years grew to $580,000. Average rate of return, there you go, that 10% again. So worst year, though, you got to see here is a negative 32%. So as an investor, you have to be able to accept that volatility in the portfolio in order to attain greater rates of return. So again, your portfolio allocation is going to depend on your risk tolerance. It's going to depend on when you need the money from your portfolio, how soon you're going to retire, and how much money you need. It could be depending on when your kids are going to college, and so on and so forth. So history has told us over and over again that the longer you're in equities, the greater the rate of return, and they do have a tendency to outpace stocks and bonds. Of course, past performance isn't any guarantee of future results. Over time, you want to rebalance your portfolio. Basically, as you approach your goals, your portfolio could end up having too much in maybe, in this example here, over 20 years, the investor started with 60% in bonds, 40% in stocks, but at the end of the 20 years, they ended up with 53% in stocks and 47% in bonds. The stocks basically outpaced the bonds. And so at that point in time, it would be a good time for them to rebalance and reallocate according to their goals.
Well, I've spent my life trying to convince people of investing for the long term. Listen, if I knew how to double my money tomorrow, I'd probably invest for the short term too. It's much easier to invest for the long term if you're just talking pure investment, because you know what's going to, in my view, the very high probability what's going to happen 10 and 20 years from now in a major way, and I don't have the faintest idea what's going to happen tomorrow or next week.
Whether you're going to make an investment in a company or whether you're going to buy the company, what are the factors that you have to be, that you're looking for? What test? I'm
looking for durable competitive advantage. I'm looking for something that has a moat around it for a considerable period of time, and I'm looking for an honest and able management to run it, because I don't know how to run it myself. And I'm looking for a purchase price that's not excessive. But it's better to pay a little too much for something that's a very good business than it is to buy some bargain, but really a company without much of a future. And I don't know, I don't have a ability to predict with a high probability of success the future of most companies. So I'm looking for the exception. But the nice thing is, if there's thousands of companies out there, I really only have to be right on a couple. I mean, it's exactly the opposite of baseball, where you have called strikes, and the pitcher's trying to throw it to you at the worst part of the strike zone for you. And if he succeeds in getting into that corner 3 times and you don't swing, you're out. And investing, it's a no called strike thing. So I can sit there all day and somebody can throw me one company after another, and finally I get one in my sweet spot.
Charlie Munger added what to you?
Oh, Charlie Munger changed my views. He refined them in a huge way in terms of looking for the quality companies and looking for the ability to make an investment that would work out well for 5 or 10 or 20 years, as opposed to something there might be one, I call it cigar butt investing, where there was one puff left in the cigar, but the cigar was free, so you picked up these disgusting looking things and got one puff out of them and went on to another one. And that worked okay, but it was small scale, and it really doesn't build something satisfying. So he kept forcing me in the direction of saying, is this really a business we want to own for forever? And do we want to get associated? It's like a marriage. I mean, do you want to get associated with this person forever? And it's a great way to look at things.
Diversification has a downside. The downside is that it's two things. One, that your portfolio will never do as well as the top performing asset class, but on the other side, it will never do as poorly as the worst performing asset class. So once again, that's the whole point about diversification and the use, our use of modern portfolio theory as the foundational tool in developing portfolio strategies for our clients.